Good evening, ladies and gentlemen, and bondholders are done. They're done with this market. They're done with everything. They just want out. The pain and suffering is really getting to them, and as in sight, there is no relief yet. The stock market, basically, as you can tell, pretty blood red across the week spectrum except for the bigger cap stocks. The S&P did have a range bound week, kind of breaking through the lows, but false breakout there. However, its counterpart, the Nasdaq, had a breakout, filling the gap that we talked about on the last week in Deep Dive, and we'll dive into this and more. But first, let's just quickly go over some of the highlights of the week. On Monday, we had Jerome Powell speaking, and that was pretty much a big nothing burger. However, we did get supplemented with Jamie Dimon coming out and saying 7% rates on the 10, 20, or 30 year are coming very soon. When asked to confirm his assumptions, he said absolutely yes. So that was a pretty big bombshell. We covered that video this week and you guys really like that. So Tuesday we had Jolt job openings, and that blew out of the waters, nearly 1 million more job openings. However, throw it down in the comment section below. Do you guys in your companies see that there's job postings? However, they're just posting them just to see who's out there rather than actually being able to hire for them? Or is there actual open jobs in the sense that someone that applies as qualified will get hired for it? Throw it down in the comment section below. I am curious to see what is happening in your neck of the woods. We had OPEC on Wednesday basically confirming their outlook for their oil projections, not really changing anything. However, that was taken very bearish since everyone was expecting maybe some more extension of cuts. We had ADP non-farm employment change come in. That was below expectation. So you had muddying the waters prior going to that big Friday payroll day. On Thursday, we had initial jobless claims basically come in better than expected, but still nothing completely out there. We had Fed Messer speaking, kind of rocking the boat a little bit along with some other Fed speakers. However, the big daddy news, non-farm payrolls comes out, blows out double nearly. No one was expecting that, and I basically wasn't expecting either. I thought Jolts was just kind of floating job openings, but that doesn't necessarily mean payrolls are going to increase. But payrolls just completely washed out any bad news from this month. Previous month was revised higher, but the market took it as a good news. However, bonds also did similarly. Bonds kept going up, up, and up with no remorse on the 30, 20, or 10-year yield, just pounding up higher. And yet again, the yield curve inversion is basically screaming its head off that bondholders are completely underwater. The Fed is holding their head underwater. The bubbles have stopped about 3 months ago, and the Fed's still not convinced that they're dead. So they're going to keep holding their head underwater, and it's going to be a very interesting time for bondholders. We'll talk about that in the key level section of the video. However, Fatal's first going to give you the biggest winners and losers, and I'll be back for the key level section.
This week, the market looked like it was going to end up in a slump. However, after surging job numbers, the market did seem that it was going to go significantly lower. However, for some reason, this thing decided to spike up, ending the week at 0.38% up, and just on Friday alone, this thing gained 1.18%. When it comes to this past earnings, there really wasn't anything major. The ones that were notable were McCormick on Tuesday and Levi's on Thursday. Coming now into the heat map, we can see that this is very 50-50, however, slightly brought up by the mega caps. Taking a look at the technology sector, we can see here that the worst performer was the company First Solar, losing 8.06%, and the best performer was the company Arista Networks, gaining 5.5%. The communications sector was very interesting. Here, the worst performer was Paramount Global, losing 8.37%, and the best performer was Live Nations Entertainment, gaining 5.38%, with Google and Meta also gaining higher than 5%. The consumer defensives has been on a complete downturn recently. In fact, Coca-Cola and Pepsi, one of the two ones that barely moved, just fell more than 5%. I just did a video on both of these guys, so make sure to check it out if you'd like to see a fundamental analysis on both. And of course, get my opinion as to which one I believe is better. Now, when it comes to the worst performer here, it will be the company McCormick, which lost 14.66%, and the best performer would be none other than the company Lamb Weston Holdings, gaining 1.09%. The The healthcare sector is very 50-50. Worst performer here was the company Dexcom, losing 10.8%. And the best performer was, right next to it, same exact industry, was the company Edwards Lifesciences Corporation, gaining 6.38%. The financial sector is looking to be a very red sector this upcoming week, seeing that on Friday the 13th, yeah, that's right, Friday the 13th, JP Morgan and Citigroup both report earnings. So that's going to be really interesting to see, and we will be live streaming on Friday as well. Nonetheless though, worst performer here was the company Charles Schwab, losing 6.16%, and the best performer was the company Market Access Holdings, gaining 11.74%. The consumer discretionary, similar to that of the consumer staples, is also very much in the red. Worst performer here was Hasbro, losing 11.16%. However, we can also see that Domino's Pizza fell almost 10%, McDonald's falling almost 5.8%, and Airbnb falling almost 8%. Again, worst performer was Hasbro, losing 11.16%, and the best performer was the company Tesla, gaining 4.12%. The industrials is a little bit 50-50, as y'all can see over here. Worst performer was the company Quanta Service Inc., losing 7.68%, and the best performer was Copart, gaining 4.04%. The real estate sector has been on a massive decline as of recently, and I gotta point it out, realty income, guys, is actually above $50 one more time. So if you managed to buy this thing sub 50, congratulations. Now the worst performer here was the company Boston Properties, losing 10.5%, and the best performer was the company CoStar Group, gaining 4.88%. Now the utilities is by far one of the most defensive sectors. However, this past week it was just an absolute bloodbath, mainly with NEE falling at 12.31%. However, the worst performer in this sector was the company AES Corp, losing 18.09%, and the best performer was the company ATO, Atmos Energy, gaining almost 2.5%. And even though crude oil has been surging these past few days, as of recently has actually come down now sub 90, and this you can see very clearly with the energy sector being a complete ruby, all except for two companies. Worst performer here, it is none other than the company Valero Energy Corp, losing 10.71%. However, guys, you have Phillips 66 losing 9.12, ExxonMobil 8.85, Chevron 3.79. All of these have just massive amount of losses. Best performer here though was the company EQT, gaining 5.45%, as well as PXD gaining 3.43%, and One OK Inc. gained only a little bit at 0.11%. And lastly, we're taking a look at the basic materials. Worst performer here was International Flavors and Fragrances, losing 7.6%, and the best performer was the company Martin Marietta Materials, gaining 5.41%. All in all, the market was very interesting. Job numbers did come in smoking hot, and well, the market fell like 1% pre-market and then absolutely rebounded plus 1% by the end of the day. Now this is going to be really interesting this next upcoming weeks, because earnings season will soon begin again. So be ready for a lot more live streams and a lot more videos from us. So with that said, take it away, Mike.
So guys, like I mentioned in the beginning of the video, the S&P pretty much had a range bound week. We did have wicks towards the bottom, breaking out of the range. However, nothing on a closing basis. Down there we had one day that was kind of like meh, but again, really didn't confirm it with the NASDAQ. And the NASDAQ, I was saying in last weekend's deep dive video that until the NASDAQ breaks, I'm not going to be convinced that this is a true breakout on the S&P either way. So NASDAQ breaking above, its next test is clearly the 50-day moving average. So we can draw out these lines. I'm actually going to keep the bottom break for both the S&P and the NASDAQ, keeping the S&P level basically the same. I want to see if it can expand out of this territory that's been in. NASDAQ, I'm basically going to be looking for, can we come to the 50? That's going to be my assumption for the week. And we do have this range that we could be in. I'm going to keep moving this chart over the course of the days just because it is a moving average. It's going to move. So right now we're sitting at 367.74. That's our bullish break target or resistance. You basically have to decide on your own. I do like for the bulls that we do have this green large volume. That's a strong move, strong push on volume. You know, might think about volume. I don't like seeing price action that's not supported by large volume. So that checks all the boxes for me. So could this be the start of a new W forming? Well, maybe. I'm not 100% sure. This could also be an A to B pattern setting itself on the way up or down, A to B, B to C, projecting down towards that moving average down around the 330s. However, if this is a smaller A to B pattern, let's say here, projecting upwards, we did complete that. So now that we've completed that pattern, there's nothing really necessarily saying to go higher. However, this is a traditional short squeeze that could definitely send us going higher. So there's nothing much really to discuss there. S&P for 22.29, again, I sound like a broken record with that number, and for 32.27 as your breakout range. Again, possible setup of an A to B pattern on the way down that would project S&P significantly lower, and we do have the existing A to B pattern basically here. So let's say we get a range bound up there, and then basically project us to 403 back to the 400s, which would return the S&P to more sanity in my opinion. However, people have contrary opinions of that. Along with the NASDAQ, that's going to be your telltale sign. Do you get a bounce of that? And now I really want to go to the Russell. The Russell is going to be one of those interesting things that IWM, if you guys want to trade on the regular market or if you trade futures, you already know about Russell. So this is a classic A to B pattern on the way down that is confirmed. So let's see if we draw this A to B pattern. We did not hit it yet. However, we came very close to it. So let's just, for the sake of argument's sakes, say that's a completed A to B pattern. Are we setting up another A to B leg again, completing down towards that 163, which would be coincidental considering that if you took the less conservative A to B pattern, would also complete down in that 162 on the Russell. So the smaller cap stocks are basically screaming that, hey, a recession is coming. We're basically heading forward. We're basically tapping the lows of March, April, and possibly going towards those previous 2022 lows. So again, with the Russell, it's going to be very, very interesting. Looking at the weekly range for the Russell, it's a pretty massive spread. So you got a long way to the bottom. That's a fair assessment there. However, we do have a pretty wide range for the Russell going into next week. So 176.73 would be your breakout, and that would kind of invalidate that A to B pattern because you're coming up to the pivot point up here. Or if you just simply break down below the 169.09, making a new low. So probably a continuation of that trend in the Russell. That would be one of the more confident patterns that I have out there. Let's just take a look at the Dow Jones, and the Dow is basically breaking completely below all the moving averages. So this is similar to the Russell. You go to the weekly, you spin out, well, coincidentally, your resistance is all the moving averages. Your support is the wick or recent low that you basically form here. So the question is, with the Dow, can you confirm a break of above 335.41, which is the 200-day moving average, or at least 334.61, which is your 50 weekly moving average? And then can you come back down to retest this low at 328.48? That's going to be the ultimate test. Volume is ramping and ramping back down, so we could see maybe a reignition of this rally to the upside or a dump to the downside. In my opinion, it's a 50-50 split just because how close you are to these moving averages. With the Russell and the Dow Jones, you really cannot necessarily tell where they're going. However, the heat map that I showed previously is a pretty good indication of how the broader market is treating it. The big stocks are leading this market. That's why S&P and NASDAQ have better performance. And historically, that means that the S&P and NASDAQ are the liars in this situation, that they're indication of a more bearish trend in the longer term. However, we do have short-term bounces. If we just go simply back to what happened in 2022, as you can see here, massive rips to the upside, massive rips to the downside. So we are going to expect some larger volatility. And speaking of volatility, let's take a look at the VIX and let's see what it's doing. Now, we had a nice higher high and a higher low. So this is a bullish trend. Again, if you guys can see it, do one divide by whatever symbol you're looking at. It gives you a different perspective on it and is a strong indication. As you can see here, we bounced and rotated off that 1288 a couple weeks ago and still have been moving up higher until the VIX makes a new lower low. I'm going to stay on the train of being a more bearish skewed trade versus a bullish skewed trade during the week. However, we have not gone above the 20s or relatively closed above the 20s, and we haven't gone above the 40s. So again, the 40s is where you find a true bottom. 30s is where carnage really starts. So we can get there in a very large hurry. Case and point, if you go back in history, this spike in 2020 basically was absolutely massive. It took about 3-4 days to get into the hundreds nearly. So When they say they can't happen, it can't happen. Dollar is basically coming back to this trend line. That's going to be the true test for the week. Is the dollar going to break the trend line? Similar to how I was telling you guys about oil, is the dollar going to be the next oil prediction I had, where it would break the trend line and then you go bearish on it and that would be bullish for the market? Or is this going to be one of these many scenarios here of this just being a simple pullback? I think once we get the lovely CPI data this week and the bank earnings, that's pretty much going to determine the next moves ahead for that. And I would like to talk about yields. However, I do want to shout out a channel that I follow. Joe Brown from Heresy Financial did a fantastic video on basically interest rates and how they're breaking the market. I will have that link down in the description below. Go check it out. It's a really good watch, and I do like his channel a lot, so just trying to shout out a fellow YouTuber out there. But before I digress, let's just take a look at those lovely yields. So the yields basically, I said in the beginning of the video that the Fed is holding bondholders underwater. The bubbles have stopped, and bondholders are banks, guys. The Fed is holding the banks underwater, and there is no relief in sight. We're basically going to the yield curve. This means Armageddon is coming. The uninversion probably can be seen on a weekly basis. Well, you can clearly tell me where this is going. Straight down off a cliff, similarly to here, and here, and that's .com 2008. And if I have to beat the dead horse that they say, take a look at the 1990s, where straight line down. So very similar to what's happening now. We just have to keep an eye on it. I am curious if my theory is going to play out, which double top, and then as 6 months from the double top is when all hell breaks loose. That will put you somewhere in the time frame of Christmas. So is the Fed going to ignite a Krampus rally, or is Santa Claus coming to town? Throw it down in the comment section below, and if you guys wouldn't mind, hit the like button. It really helps the YouTube algorithm, and it doesn't take you very much effort or time. Thank you very much for that as well. So the 20-year basically pushing the new highs. I didn't think this was possible. I thought the short-term yields were going to calm down. 20-year straight line on parabolic, no relief in sight, and no sign that it's going to be stopping. We're going to have to be very interested in that. 30-year, similar story, knocking on the door of the 5%, which is absolute insanity. If it gets close or even remotely close to that 5%, we'll most likely see a complete uninversion of the yield curve, meaning that Armageddon, the Grim Reaper, is coming to town as usual. And just a friendly reminder, the famous meme that I always post on the channel, the Fed basically going for those who think they've bought the bottom, but it's really not going to be the Fed. It's more about going to be the yields just ripping everyone's face off completely and having no mercy for anyone whatsoever. And again, we got Bank of America earnings this week. Sorry, JP Morgan, Goldman Sachs, I believe, Citi, Bank of America is the following week. So that's going to be very interesting. But let's just quickly recap the news for next week. Starting off with Monday, nothing real much. We've got a couple Fed speakers. Tuesday, similar story there. We get PPI, which is going to be a sprinkling of what is expected. But then on Thursday is really the first big hurdle of news with CPI. We don't have expectations now, and we will publish that video when it comes out, guys, around probably Wednesday or Tuesday. Be on the lookout for that CPI prep video that will cover what the expectations are, what we think they're going to come out, what's the market reaction, where the market is going into CPI. So crucial information for you guys there. And then as always, Friday, we're going to have the standard net speculative positions, which I did forget to go over. So let's just quickly take a look at the net speculative positions for this previous week, just to see what they came in at. And again, previously or now capitulating some more as the market's coming back down, closing their positions. So are we setting up to go long on the market here, because they do have 1, 2, and traditionally that's when they go long, but we haven't seen it go back to zero yet, so we'll keep you appraised of that. However, I do want to start off and talk about the CPI as always in the debate section of the video. So thank you so much for watching, and we'll get into the debate section now. So if you guys just want to minimize it, feel free to. So guys, we're going to talk about CPI first, like always. Just going to give you our own quick personal thoughts. I don't want to linger it on too much, just because one, we don't have the expectations, and we will do a video prior to Thursday talking about CPI once the expectations come out. So I'll start off. I think it's actually going to come in kind of just flat, like very muted, because oil really hasn't pushed gas prices too high. I think it will get back to a flat number for energy. I don't think you'll have a negative for the category. I do think previously I went 3.7. I could see a 3.8 or a 3.9 expectation versus, and then for the for the year over year regular CPI, it goes up, and then core most likely would be like a 4.0, 4.1. That's what I would be expecting, because those two have been diverging recently, and there's nothing really that's changed the trajectory in my opinion.
So, okay, my thing is that, remember, the CPI takes a look at last month. And last month, we did have oil skyrocket. So, I get that right now, obviously, we have seen crude come down a little bit. We're off from the peaks of just this year to date alone of what, like 93, 94, down to now being roughly, 80 something? Yep. 81, 82. So, I get where you're coming from with that, but remember that this CPI takes a look at last month's. So
fair,
just keep that in mind.
But it's also comparing the previous year's data, which if you look at the AAA gas prices that I have pulled up here, if you look at the year ago here, it's 3.79 versus 3.814. So it's roughly about the same. So you're weighing it against a current price that you necessarily are super elevated from.
Okay. If you're taking a look at the year-over-year one, yes. I was mainly talking about like the month-over-month one. But even the month-over-month one, honestly, it could still roughly remain the same.
Yeah,
right?
They're expecting core to remain the same, but they're expecting the CPI month-over-month to actually go tick down from its crazy 0.6 value that it had before.
Yeah, I don't necessarily know. I think the year-over-year one though will remain roughly the same. Maybe go down by 0.1, right? Maybe like around 3.6. Yeah, 3.5, 3.6. Maybe even just stay the same as 3.7. So, but no matter what happens, the markets are going to take a look at the one that benefits them.
Like they did last time.
Yeah. So like if core goes down, but the normal one stays the same, then they'll look at the core one. But if it's the opposite, then they'll look at the other one. So it's, they look at the one that benefits them the most. Now, yeah.
Would you agree that CPI has lost its shiny new, like brand spanking new car feeling, and now they're pivoting to job numbers?
Yes and no, I guess. I mean, jobs just came in. I think that they go to the one that I wasn't say benefits them the most, but
confirmation bias.
Yeah. But I mean, jobs came in today smashing. Now I don't know the exact number.
So I'll give you a guess. What do you think? It was expected to be 170K.
Okay, so I know that they surged. I did hear the surge part, so I'm gonna double that. Like maybe like 300,000.
And we have winner chicken dinner, 336,000.
I mean, I saw surge. I saw surge because like Seeking Alpha, like I'm over here watching Seeking Alpha, and they usually plop it, but I didn't see the exact number. But yeah, that's even crazy.
Worse is they tacked on roughly another 50,000 for the previous month jobs. So even when we saw a degradation report last month, that report was completely wiped out. They said, "Oh, look at all these jobs created. Here, look, squirrel, look at the shiny nut."
Right. Yeah, it's just crazy. So the market fell. And again, I love it because you would think, man, we added so many jobs. That's great for the economy. Oh, but so why is the market falling? I don't understand. It's because this gives Powell more of a reason to say, all right, we're going to increase interest rates. Yeah. So there you go.
And then market fell like instantly. Like you got the instant knee-jerk reaction.
Instant.
And then
it was down like 1%. Dude, it was down 1% on the S&P and the NASDAQ pre-market.
Yep.
That never happens.
And literally pumped it that 1%, pumped it another 1%. NASDAQ closed 1.68% green, 1.19% green on S&P. So they were just like, wait,
they did a net of
let's
2%.
let's ignore the unemployment rate going up. Let's ignore jobs, people having jobs. Let's ignore
the unemployment rate. The unemployment rate didn't go up. The unemployment rate remained the same.
Oh, correction. So they expected it to go down, but then it remained the same. Okay.
Yeah.
So
which is actually it's against them. Yeah. Right? Because you want unemployment to go up, but if it stays the same, then If it stays the same and yet you're putting in that much job, what does it say? This is what amazes me. What does it say when? And I'm not asking this as a question like to get an answer. It's more of a hypothetical. But just think about what does it say about unemployment remaining the same, yet adding a smashing jobs report of 336,000. That doesn't make any sense.
No, it does if you understand how they calculate it. They look at you having two jobs. Right. As two jobs, not one person having two jobs. It's two jobs. So therefore, that means that you're employed, but you're still seeking more employment because inflation has torn a gigantic hole in your wallet.
I'm not so sure about that, but I'm not so sure about that specifically, but I don't think they count as unemployed. No, I don't think they count that as unemployed, dude.
No, but I think that it gives. You have explain like the non-farm payrolls for unemployment is because you have a lot of people seeking jobs still. You're not really. It's unemployment's a very finicky one because you're seeking jobs and participating in the labor market. So as more people kind of come off government subsidies or different like people graduating college and they're looking for jobs, they're considered unemployed, and it basically feeds into that metric. So right. What's interesting is the average hourly earnings starting to cool off. It's like are you starting to see the damage that the Fed has done to the economy? Is that now finally, after over a year, finally coming through? Because remember around this time what was happening? The 75 basis point hikes. Yeah.
Well, I'm gonna add on to that. The answer is no. Do we see the effects of the Fed? No. You know why?
Why?
Unemployment is still at 3.8. They want unemployment to be close to 5. We have a long way to go for that. So the fact that they want inflation to go down to 2, and the fact that they want unemployment rates to go up to around 5, and we're still not anywhere near either of them, says something, right? And on top of that, the more non-farm payrolls jobs that that we keep smashing. There's been only a few months this year where it actually came on par or slightly below expectations.
To only have it rip right back up on the next report.
Right. It's just like a small dip and then it just boom, skyrockets. So I don't see any of this. This is why I'm like, why are they pausing interest rates? Like, I'm not a fan of the Fed. I'm not a fan of them increasing interest rates. I'm all for end the Fed, right? I'm all for an end the Fed kind of guy. But man, if you're going to have the power to raise interest rates, if you're going to have the power to do that, use it, right? If you're really wanting to bring down inflation, which by the way, they're not bringing down anything, right?
If they want to bring it down, they want the jawbone. They want to say, well, we're gonna raise rates by 75 basis points in 3 months. Why not raise it now? Oh, we'll do it in 3 months.
The whole thing is like, it's like they want to drop inflation. They're not dropping anything. If they wanted to drop it, they would want to bring inflation to a negative, right? We want to have deflation, but they just want to slow down the rate of inflation. We should probably start saying that from now on because they don't want to stop inflation. All they want to do is slow down the rate of inflation. That really all that is, right? It's all a lie. They're all lying when they're like, we want to bring down inflation to 2%. No, they don't. They're not bringing down anything. So the fact of the matter is that we're still far away from a 5% unemployment. We're still far away from a 2% increase in CPI. So why do they stop?
I think you've answered this on the channel before. It's the classic, okay, we're going to hike and we're going to see if something breaks, right? And nothing broke. Yep. Okay, we can hike again. And it's like this game of hike, pause, which is the first time in history they've ever done it.
The first time that they paused, I said, I think we're going to get a hike, pause. I think we're going to do this. Think about it. They went from a 75 down to a 50, down to 25, and now they can't just stop. So they're like, hike, pause. I think it makes sense. And I think the next step would just be complete pause. And then the next step after that will be, then they're going to start cutting.
So but naturally, this leads to the question of, what do you think they're going to do in the November meeting?
I think they're going to hike.
So I could actually say they could pause for a couple of reasons, and we'll get into that shortly. But looking at the CME tool, we're right smack back at 88% expectations that
Didn't this change?
It was
just change
60. It was 60 about 3 days ago. It actually doesn't show here, but it was 66% of a pause, and then went the second we got the jobs report, whoomp, right back up to this expectation.
You know, we should probably. I'm half tempted to make like a spreadsheet for people and just update it daily with like the graphs of like how this is actually moving. Just so that we can actually see
the insanity.
Just so that we can see like the overall like flow of like what people are thinking on a daily basis. You get me?
Yeah.
I think that'd be cool. I might make it and just type in the number every day and just make like the graph.
Yep.
Right. I think
we
that'd be
actually
cool.
I was looking.
Oh boy.
Yeah, we had fear and greed hit 22, but there was one chart here that I really wanted to show.
Okay.
Hiring surge keeps door open for Fed to increase rates.
And there we go.
The dotted line is the 2017-2019 average. As you can see here, we're significantly above it. And
wait, what?
The dotted line.
What do you mean the dotted line is that's the average for a job opening, like for non-farm
2019 for non-farm payrolls.
That's crazy. Was that low?
Well, it was only usually you only have 100 to 150K non-farm payrolls. Huh. As you can see here in the year 23 and 22, look at the craziness you had.
Well, I guess you can explain that with just COVID, right?
Yeah,
jobs that were closed are not opening.
This was COVID, but look, you still had an elevated level significantly above. Like you talked about, you had 1 month that was like below, and then instantly spike, and spike again.
Yep.
So we had a interesting thing, and again, that feeds into this, which... Do you really care what a bunch of analysts say? For me, I care about what the bond market says. And the bond market, well, I think bond holders of long-term rates are screaming, absolutely screaming bloody murder. The 30-year touching 5% today. When I saw this, I'm like, well, I would say the car's left the cliff, but I don't think it's a cliff. I think we're just like floating in outer space at this point.
So the yield curve has been uninverting.
Oh, that's the worst part of how it's uninverting. The 2-year, if we take a look at it shortly, is just flat. So the 2-year is actually not moving. Historically, the uninversion of the yield curve is the short-term end yields, the 2, collapses while the 10 stays flat.
Right. While the other, while the much, the
longer
later
term
maturity ones, go up, or at least stay the same. Sorry.
Yep.
So the fact of the matter is that. So what you're saying is that the uninversion's happening with the shorter term staying flat, not coming down, but staying flat, while the longer term ones are spiking.
Correct.
I mean...
Which has never happened in history.
Right. Wait, which what?
Has never, ever happened in history. This is the first time it has ever happened in history. Every uninversion previous to this one has been the... inversion of the 2 and the 10 where the 2 comes back down. It has never went 2 stays and 10 spikes. So
we are in unprecedented territory. Because I have no idea what that would mean. Well, because you would think that well, here's the thing, right? I get that it's uninverting, but it's uninverting in a way that's not we haven't seen before. So
yeah, it's just
uninverting higher.
Yeah, well, for example, if you're a bank, right? TLT, you bought. Okay. Let's see, you back in 2020, you bought at these ridiculous rates up here.
Hang on, TLT guys, it is the ETF for I believe the 30-year or 20-year. Okay.
So it's the famous one that you can use this as like what banks mainly buy. 20 years common for banks.
Yeah.
So you bought at, let's say, we'll use the median around here, 153. I'm just using it as a number so everyone can associate. Then the Fed went on a hiking spree that devalued your entire portfolio by 32%. Then in October, you were devalued at 42%, but then you gained back about 10%, which landed you at a 30% devaluation. So you were breathing a sigh of relief, thinking, okay, the Fed's done. This is going into April and March of 23. Everything's hunky-dory, soft landing. Well, sad to say, your portfolio is devalued at 44% now, And the Fed is basically telling these banks, oh yeah, you have to have stricter margin requirements and capital requirements after you've devalued all your assets that we force you to hold as 44% haircuts.
Yeah, that's crazy. That's crazy. And funny you bring banks up because we're soon going to have earnings season again, and guess who's first? Guess who is first?
Morgan.
Well, the banks, right? The banks. So we're gonna be doing that. That's already starting what, next week? That's crazy.
Friday.
Was that
Friday. So we got Thursday CPI and Friday banks.
Oh man. So guys, we are gonna live stream this, all right? Like every single earnings season, when it comes to like the big ones, the banks, tech, that kind of stuff, we are going to live stream it, okay? So yeah, we're going to, it's already next week. Joy. This is gonna be fun. This is gonna be fun. Last time, the JP Morgan and Bank of America were like, no, everything's fine. Wells Fargo, Citi were like, nah. But then at the same time, you had the article where Bank of America was underwater by what, 100 billion?
100 billion paper loss. So just to clarify, that is not an actual loss they took. It's on paper. Now, meaning if they had a bank run similar to FRC and SVB, they would be taking that haircut. However, I'd just like to bring that to the audience attention. That was when you were here. So that paper loss just got another 20% worse. So, ow.
Yeah. Yeah, that's really bad. This is gonna be an interesting one, guys, because here's the thing, interest rates, if they keep going up, this is going to come down. Yields are going to keep going up. Now, if banks start to report bad again, oh boy, get ready for this.
And
because this is going to be bad.
They were reporting around here, so they were like thinking when they were giving their guidance, right? So bad time here, super bad, but yeah, we're okay. We're above water. The bubbles have we still got some bubbles coming up above the water. The Fed hasn't drowned us yet. And then the bond market basically said, "Hold my beer." And goodbye to your portfolio, because they're holding 30s, they're holding 20s, and they're holding 10s. And there was no remorse. The bond market has no remorse for these banks. They basically said, you're so underwater that I think you can see the Titanic from where you're at now.
the Titanic is like way above them already.
Yeah. So we're in the Marianas Trench at this point of underwater. Marianas Trench. But regardless, it's so bad. And I do want to pull up Carey. So the regional banks. If everything was hunky-dory, right? We're playing this hypothetical scenario, soft landing. You've had almost a year, about 3/4 of a year, sorry, to buy regional banks at discounted prices, and no one wants to do it. Why? Well, if it's so discounted, if you are so in love with this bull market that everyone perceives it as, why aren't you buying a regional bank for nearly, from where its current price is, 35% off? That's a great deal.
Yep.
Unless people expect another shoe to drop, like Warren Buffett has said. Look at even the bigger banks, Bank of America. You broke the low of the FRC low. So this was what happened when FRC came out. This was SVB here. And it was just just absolute carnage. There's no catalyst for this unless people don't want to hold financial institutions. They're shying away from it. Obviously, JP Morgan being Mr. Strongman in this and looking how many banks he can buy once this all starts. But look at Citi, near the lows.
Which, by the way, is my theory as to what's all this happening. And by the way, in regards to Citi, I saw an article today that they just announced that they're going to start, I guess, not tracking, but valuing employees. Not valuing, but like figuring out which employee to lay off.
Employee.
Yeah.
But I thought it was good times ahead.
Yeah, it's crazy. Like Citi straight up was just like, no, we're gonna start laying off employees soon. We're gonna evaluate employees now, and we're going to start laying off people. Let me see if I can find the exact. Yep. Citigroup begins reviewing employees for layoffs, reassignments reports. So this is going to be fun. And then actually, let me just divert a little bit here from banks to consumers, because two of the biggest companies out there, and I just did a video on them, guys, just fell 5% in regards to this. Look at that. In regards to this upcoming earnings. Take a look at that, guys. PepsiCo just fell. Look at that. Can you zoom in on that?
Sure.
Zoom in on that candle right there. Look at that candle. PepsiCo dragged all of the beverages down. Monster, Coca-Cola, like all of these. It just dragged it down. So
we have your favorites reporting Tuesday.
Yeah. And then now look up also Texas Roadhouse, TXRH. This thing has fallen down to now sub, I believe, $95, if I'm not mistaken. What's that now? Or did it go above, slightly above? Okay, but it was sub 95 just a few days ago. So the consumers, both staples and the discretionaries are collapsing right now, guys. Collapsing. So maybe a bad time to sell cash secured puts unless you actually do want to own those companies. And another sector that has been collapsing is the REIT sector. Mike, take a look at the company VICI.
Well, I also have real estate sector.
Oh, you have the real estate sector right there. Look at that. XLRE.
You're coming back down. Yep, XLRE. Coming back down towards the October lows. So it's as more, and you can actually go through a bunch of sectors, and you're seeing a lot of them either breaking the October low or coming down close to it. So it's a lot of carnage.
And let me add another sector to that as well. XLU, we just did a video on that one just a few days ago. This was also down a massive amount, guys, the utility. So you have consumer defensive / discretionary falling off a cliff right now. You have REITs, which, guys, REITs are a great way to increase that yield on those dividends because they're forced to give out minimum 90% of their net income in the form of a dividend due to regulations. However, please remember that that dividend is not qualified. It is non-qualified, so you get the full brunt of the taxes. But still, though, that's a massive, massive amount of income when it comes to REITs. Utilities is one of the most defensive sectors out there. So the fact that they're falling might serve itself as a great buying opportunity. I personally bought Southern Company. And now the consumer defensives, a company like Coca-Cola and Pepsi, are falling a massive amount. You guys can check out that video I just put out yesterday. Check it out to see the comparison between the fundamental analysis on Coca-Cola and Pepsi. This is becoming like a candy store, Mike. This is like a little kid in a candy store with unlimited buying, well, not unlimited buying power, but with a massive sale on certain sections of the candy store.
And you can always find value. That's the thing. It's like people have this misconception that even when things are falling that you can't find value. It's like, if you have an understanding of where it's going and understand the risks or reward that you're potentially playing, like for example, XLU, we talked about that in this area, I would want to see a couple candles close and it's looking like it's basing out. Now, is that basing out to finish the bear flag to crash another leg lower, or is this a rebound? Time will tell once we start getting forward price appreciation, but could be an interesting risk to reward play. As you can see here, the law of wicking tails, but it's play it at your own risk, like I would say.
Right. And when it comes to each individual company, well, I personally like to take a look at the fundamental process approach and go from there, which again, I have hundreds of videos on that. So yeah. Now, aside from that, is there anything else that we also want to cover before we go into the fear and greed, even though we can decide?
One last thing, and we'll actually two last things. I lied. So, like we mentioned, fear and greed at 29 on the close of the day. We were in extreme fear, and actually, when you got even to a 17 rating, that hasn't been down here in quite some time. Even if you look at the October lows, that's where you have to come back to the 17s, and we were at one point at the 17 closing basis. So, you know, short squeezes are a lot of potential around there. Just look at October. But the most important thing, the famous thing I love covering on this channel, the yield curve. And this thing is just uninverting like no tomorrow. And the Fed
just look at that
is panicking because their piggy bank, this is not even the worst part, their piggy bank is getting drained. We're at 1.28 trillion. Last weekend we were in the 1.4 trillion. They're knocking up about 100 to 150 billion dollars a week. So it will take some time to drain. However, we are starting to see further and further acceleration of how low this thing is accelerating towards the lows. And this is used to control short-term yields. This is not used to control or have any influence on longer-term yields, even though the Fed hopes for that. But that's why you have this inversion. They're keeping the two suppressed because otherwise it'll be skyrocketing. And the 10 is just saying, hey, I want to join the 2 up there. We'll keep you guys updated. We're slowly approaching the anniversary of the Great Financial Crisis inversion length. That means this, in order for us to be shorter, this line needs to get below the white line before the yellow line crosses. So I do think, I got my theory, that once we have a double top, it's about 6 months from the secondary top, which will put you around Christmas or beginning of New Year's. So we get a Santa Claus or Krampus rally, as I would like to call it, because throw it down in the comment section below. Do you guys think we're going to get a Santa Claus rally like everyone thinks we are? Or the bank's going to put a sour note on Friday the 13th for us to start off earnings season to kick off.
Oh my God.
To kick off the Krampus rally.
This is Friday the 13th. This is what JP Morgan reports. That's right. That's right. And then let me add something that, well, it just happened, guys. It finally just happened. And this is why I'm like, I don't think we're going to get a Santa Claus rally. We might, obviously. We might. Student loans just started getting repaid. So it's October. Student loans finally started to get, to get implemented. You think people are going to have money for that? No.
And I actually saw an article.
$1 trillion. Hang on. And on top of that, $1 trillion in credit card debt.
Again, so, I like to just say the yield curve inversion's got a really good track record of predicting when everything goes belly up, and this is the most severe inversion. If you go to the weekly, it kind of paints a very clear picture of what's coming next.
Which is? Show us.
This federal funds rate comes back down to here.
Well, that means that they would have to start cutting.
Here's a redonkulous prediction. I would not be surprised to see the Fed cut rates prior to end of this year.
That's a bold statement.
Now,
that's a bold statement. We haven't seen anything with the dot plot about that.
Fair, but this is telling me that something is broken. Not publicly, but something is fundamentally broken. They broke something because the bond market is significantly times bigger than the stock market. That's where all the governments trade. You can't really hide anything in the bond market. So all the big players know something's broken. Otherwise, the short-term rates would continue to keep going up. The 10-year would not be doing what it's doing now, and the reverse repo wouldn't be draining. Something is broken. Now, do we see it? Does the market see it? Soon or rather later? Regardless of which option it is, it's like picking, are you going to get shot in the foot or in the chest? Because you're getting shot regardless, and you just have to pick how painful it's going to be.
So, guys, this is going to be crazy, and I think we're going to get our answer when the banks report. Again, that is next week. First one, JP Morgan.
Friday the 13th.
Friday the 13th. So, guys, that pretty much does it for this video. Y'all can follow us on the New Tech Sites. Link is in the description below. Make sure to like, subscribe, comment. It really does help here on YouTube as well as Rumble. The goal, it is 3,000 subs by the end of the year on YouTube. And if we reach that, Mike will begin to do face cam when it comes to his videos. And 200 subscribers on Rumble. So, let's make it happen, guys. We're asking for something free in return. We're giving you guys free stuff every single day. So the least we could do is just, ask you guys for something free in return. It takes less than a second. So like, subscribe, comment really does help. So with that said, peace out, and we will see you all next time.